Thank you so much for the confirmation. So today I'm basically going to share some of the compounding secrets that I've learned through my journey through various sources. Of course, a lot from Vivek sir, a lot from social media, particularly X, a lot from the books on investing that I have read, and a lot through personal experience while managing the portfolio. A lot of realizations happen, and like it is said that it one should never do paper trading. If you have to learn the game, you have to play it properly. So when we put in our own money and when we see the prices fluctuating, when we see the results fluctuating through various modifications that we make in the process, so it gives a lot of great learnings. So this session is going to be majorly about that, and it might be a slightly stretched session because I've tried to pour in the maximum things that I can share from my end, so that there is a wider benefit in the community. And yeah, so first let me share my presentation, and then maybe we can continue with the description. Shyamji, I've sent the request for screen sharing. Shamsi, could you please check when I am trying to share the screen? It says that the host isn't allowing multiple presenter. Yeah, I think now it is great.
You can now you can do it now.
Great. So I hope my screen is visible now. Let's put it on full screen. Yeah, is the presentation visible? Great. Awesome. Thank you for the confirmation. Yeah, so as previously discussed, this session is majorly about the compounding secrets. And this is me, Nimish Shrivastava. If somebody wishes to follow my work, because I work in various domains, so the address is nimishrivastava.com. So you can just go to the website and follow my various works. So first question is, who am I? So let me quickly introduce myself with a handful of milestones that we can consider important. So I live in Bhopal, and I recorded my first music album in the year 2010. So I went to Mumbai when I was still in college, and we recorded our first music album. Then I completed my BTech honors in civil engineering from IIT Bhubaneswar in 2012. During that phase, I also acted in a Bollywood film, Lucche Lafange, as the main lead. So the film is available on YouTube. If somebody wishes to see, they can. After completing this little adventure in Bollywood, I quit the acting career, and I started up post after completing my graduation. And along with my wife, I founded the Banyan Tea, and then we ventured into another venture, Cup Party and Fanverse. So these are three of the ventures that I co-own. And I joined Technofunda Investing in the year 2022. In 1 year, I became Technofunda Wizard by beating the index by 21%. And last year, in fact, this year, we also took part in QIC as a group of diamond members from the team Vayudut, and we happened to qualify for the final rounds of the QIC as well. So this is a quick introduction about me. So what to expect from this session? So this session is essentially about the compounding secrets. So we all understand, the strategies. We all understand a lot of technofunda strategies, but still, same set of stocks, same sessions that everybody is attending. Different people are getting different results. right? So I've tried to analyze those, and I have tried to bring some secrets along so that we can ponder upon them, and um, accordingly we can understand that what is making that difference in the portfolio of different community members as such. And we will be discussing the basic or the fundamental aspects of compounding, and gradually we'll be moving forward towards the advanced concepts, or the secrets that we can call in the compounding secrets. So first thing first, let us try to understand what is compounding. So I believe all of us here in the community understand what compounding is, but still it is a very simple yet very complicated due to its innate nature. So if we these three simple equations, they speak a lot about the power of positive compounding, the negative compounding, and zero compounding. So if we start from one and just make 1% increment daily, and keep repeating it 1%, 1%, we keep improving a particular input. So after 1 year, the output will be 37.78 times from our starting value. So this is the power of positive compounding. Similarly, if we decrease or dial down on any of the aspect slightly, and then we keep on repeating that thing, say a small bad habit, say we used to eat healthy meals, and suddenly a friend of ours, or some or kid of ours put us into habit of eating sugar, and we kept on eating sugar, or we developed that sweet tooth, and we kept on taking those one toffee or one chocolate or one pastries each day, and we compound it for 365 days. So that is an example of negative compounding, which deteriorates the final output and can affect in us in a lot of negative ways. And then there is zero compounding. Any aspect of life we remained unchanged will stay unchanged. If we do not alter it at all, even for a long period of time, it will stay the same, right? So a stationary object will stay stationary unless an external force is applied to it. So something like that. So these are three equations just to understand how powerful compounding can be, either positive, negative, or if we do not move the needle at all, how much opportunity lost can be here. Of course, here is a huge difference, but we see here between the positive and zero compounding also there is a huge difference. So understanding the concept of compounding becomes really crucial in that way. So to understand compounding, let us take an example of a simple mango tree. So it is like a growing mango tree, which eventually turns into a forest over a period of over an extended period of time. So eventually, what happens? A seed is there. That seed blooms into a plant. That plant becomes a tree. Then that tree bears fruits. Then the fruits make more seeds, and those seeds turn into another, like another plant. That plant grows, then that tree also gives fruits, then there are a lot of seeds, and all those seeds turn into plants, and all those plants turn into uh, forest, into trees, and eventually from one single seed over a period of time there could be a forest of mango trees. So that is a very simple example to understand the concept of compounding. So the thing is, why should we care at all? We should care because compounding is something which, if implemented correctly, it can keep making our life easier. It can keep upgrading our wealth. It can keep upgrading our life as the time flies, because if we don't make any changes, the negative compounding is always there in this world. If we don't clean a table, dirt will be there. Second day, more dirt will be there. After a week, it will be a lot of dirt. If we see that same table after an year, it will be full of spider webs and a lot of insects. So if we do nothing, it is not like nothing will change. That negative compounding is always there in play in all spheres of our life. If we just leave anything just like that, the negative compounding will affect. If we have, say, a corpus of say 10 lakh rupees, 20 lakh rupees, and if we don't do anything, inflation is at play, and not just even by not spending a money out of that corpus, because inflation is playing its role, that the value of that corpus is decreasing, right? So why should we care? Because with positive compounding, as time flies, instead of this negative effect, we can turn the tide, and we can make money work for us. We can make our relationships work for us. We can make our health work for us, and eventually it will be like an exponential curve that will help us move smoothly in the life. So simply said, it is like tiny actions turning into big results. Let us take a few small examples. Suppose we start saving 10 rupees daily, or start reading 5 pages. So initially it may seem trivial, but if done daily, they accumulate. The habits accumulate, the tendencies accumulate, it generates momentum, and it is almost like a lot of drops coming together and ultimately forming a river, which can be explosive growth eventually. So compounding rewards one person the most. It is not for anybody else, but it will first and foremost affect one person, which is the future you. So if you care about yourself, if you care about your own future, then you need to understand the concept of compounding and implement it in your life. So it is not about taking giant leaps, because we believe that to ultimately get big results, we need to take giant leaps and take a lot of risk, but that is not how it is done. It is about consistency. It is about consistently taking those small steps that stack up over time. So, having said all of that, if compounding is so powerful, why is it not popular? Because even if in our family, like when we are talking here in the community, almost all of us are interested. But it is, if we compare it from the population of a country, or if we compare it, from our own circle, so you would find that in our own circle, amongst our friends, amongst our family members, only a handful. People understand these concepts and implement these concepts. So it is fair to say that compounding is not very popular. In fact, when we learn these things, we try to teach it to our friends, relatives, but a lot of times people don't understand the importance and they take you very lightly. I'm sure all of us would have experienced that effect ourselves. So why is it not popular? Let us first try to understand that. So the issue is that we struggle with exponential thinking. Our brain is not made in such a manner that we understand what exponential growth looks like. So to illustrate that, I'll like to share a small story, which is also popularly known as a chessboard story. So in the kingdom of Anurag, there was a king, and a sage one fine day visited the kingdom, and he gave king the game of chess. So the king saw that game for the first time and he was very happy and very amused by the game. So he uh, asked the sage that, I would like to offer you a reward. And what would you like to have? So the sage very humbly told him that I would like to ask for rice. And the only condition is that I want one grain on the first square, but as we move to the subsequent square, I want it to be doubled. So first square will have one grain, second square will have two grains, third square will have four grains, and so on. So the king thought that this is a very simple thing. It is, very easy. I believe all of us will also agree, for a king of that kind of abundance. It was a very humble request that a sage is asking for a few probably grains of rice. So the king laughed at the humble request until the math unfolded. So as the math unfolded, let us see how did it look like. So as they came to 10th square, uh, the figure was now at 1023 grains, which is how much times? 1000 times of the first square. So just by doubling on each square, on the 10th square, it was 1000 grains, still a very small amount for the king. On the 20th square, it was 1 million plus grains. So now the king, got tensed. Now the king thought, how am I able to accommodate this 1 million plus grains of rice? And he deployed all the kingdom to bring that amount of rice and count each grain of rice, because it was about the grains, not kgs. No? So 1 million grains they had to count. So the king started to become very anxious about that. And on the 30th square, it was 1 billion plus square. And on the 45th square, it was 17 trillion plus. And on the 64th square is what it was 18.4 quintillion grains. So that is the power of compounding. That is the power of exponential growth that compounding has. And our brain is not wired for that, essentially. So the humble king then realized his mistake, and He apologized to the sage, and then sage told him that I did this experiment, or I made this request just to let you know that it is not about it is more about the wisdom of the society. So that was a small short story, but it proves the point. So let us also see some more thought experiments to understand what is the difference between the linear brain and the exponential reality. So the reality is always exponential, but our brain is linear. So let us do some thought experiments. So what do you think would be a difference between 30 linear steps versus 30 exponential steps? So suppose we take 30 linear steps. So it will just be like 30 steps, like one step, second step, third step, fourth step. So maybe across a room or across a plot, easily one can take those 30 steps. Now, exponential steps means each time we have to double the step. So first we took one step, second step will be double the size of first step, third step will be double the size of the step. So what do you think would be the difference? So this is the difference. The difference is really staggering. So if you keep doubling your step size each time, you double it and you repeat the cycle for 30 times. So the distance is over 1 billion meters. And that would mean that you would circle the earth 26 times. Next, do another thought experiment, which is folding a paper 50 times. So what would be the thickness of that paper? It feels like the paper we can consider to be, say, 0.1 of thickness of paper. So what happens is each time we fold the paper, the thickness becomes twice. Then we fold it again. Now the thickness has become four times. Then we fold that paper again. So suppose if it was humanly possible to fold the paper 50 times, it is just a thought experiment. So how would the thickness look like? So we would our brain will guess that ultimately it is a paper. Even if we fold it for 50 times, it will be probably a few meters max. That is our best bet we can think of. Now let us see what the real example is. The reality is that the thickness of that paper, if it was possible to fold the paper 50 times, the thickness of that paper would be 112 million kilometers. Now, what is the distance between Earth and Sun? It is 150 million kilometers is the distance to Sun. So simple paper folding experiment, if done 50 times, the thickness of the paper, that 0.1 of the paper will cover three-fourth, almost three-fourth distance between the Earth and the Sun. So that is the power of exponential growth. That is the power of compounding. So the thing is, it's not a mistake, but ultimately our minds are built for addition. If somebody gives us additions, it is very easy. If somebody gives us simple multiplication, it is still easy. But as in when the intensity of those multiplication starts increasing, our brains start getting confused. So addition. So ideally, it is built for addition and not for multiplication. That is the major issue why we do not value compounding, or why do we fail to understand these concepts. Another issue that is very prevalent in the society is wrong wiring of the brain. So we have a very wrong mental conditioning, because even in our homes we have seen, even in our parental generation, and a lot of our friends and family members also, we see this thing that everybody wants to ultimately become rich, even in and successful. Even in Stranger's Secret, it is mentioned very well that at the age of 25, everybody wants to become successful, everybody wants to become popular, everybody wants to have riches, but everybody ultimately conforms, and they conform to the societal situation, they conform to the societal norms, and there are only a handful of people, 1%, 2%, 5% of the people who actually make the grade and who actually lead the world. So that is the issue, that conformity and the wrong mental conditioning, that we value um, magic more over systems. If somebody is giving a system where systematically an output can be achieved, versus if there is some sort of mystical or magical phenomena involved in some other process, so we tend to value magic over systems, right? So just to illustrate that, I have shared this image of Kaun Banega Crorepati. So brilliant show, definitely changed lives of a lot of people, and this show is has been on air since 25 years, and millions of people have applied for this show, and almost 1400 plus people could play the game of the millions of people who applied for this show. And over 30 contestants have won over a crore of rupees, which is great. But what we have to understand is that the probability of a person living in India getting selected in the show, reaching on the hot seat, playing the show, winning it successfully, earning that 1 crore or more, so it took Kaun Banega Crorepati, the show, and they have a lot of lifelines. The answers are also not very difficult at times, at least in the initial phase. If somebody really studies, they can crack it. But still, over a period of 25 years, only 30 contestants were able to earn more than a crore in this show. And it is a very popular show. Everybody sees that, and just believing that someday this magic will happen with me, and we are just intrigued and hooked on the screens for this show. Comparing it with something, a setup like our community, so which started in 2020, Vivek sir has led a beautiful system, a beautiful roadmap. In each on each Friday, on each Saturday, he tells us what the path is, what you need to do. He's giving us hand-holded systems, and when he has a system which has which a lot of all of us almost in the community have experienced. Still, we become very miser, and we in terms of giving time, in terms of going through the modules, in terms of following the processes. So the current count should be even higher, but this is what I could recall, that at least more than 22 plus people have become crorepati in our community, which started in 2020. And it is not about their capital, because if you think that it is about a capital, so how difficult it is to save 10 lakh rupees? It is not very difficult, right? For as a family, how difficult it is to save a mere amount of 10 lakh rupees? It is not at all difficult. If somebody has a higher portfolio, say of 50 lakh rupees, compounding at 25%, we can make it into a crore in 3 years, and then we can keep compounding from there on. But even if somebody has a smaller portfolio size, as a family, we can, save, we can contribute, and we can build a corpus of at least at 10 lakh rupees, and we can start compounding at 25%. Within 10 years, it will become crore. Within 10 years, it will become a crore. And I'm sure this phenomena will also, have that J curve. That last year, probably Vivek sir gave this award of crorepati, that we need to have more crorepati, and suddenly 21 crorepatis in our community popped up, who doubled the capital from 50 lakh rupees or more, and made the portfolio size over a crore rupees. And as and when we progress, this will ultimately, gain momentum. And but what will happen is that a proven system that people can use to actually make the multiply or compound the net worth, so it will definitely be popular, because this is a system that is magic. So that is the only difference between this. So now let us try to further go deep down into the topic, and let us try to understand compounding with real numbers. No, so all of that were stories that we discussed, and mental and models and thought experiments. Now let us dive further into it. So let us first try to understand what is the difference between a simple interest and a compounding interest. So if we take example of a simple car, so a car moving at a constant speed, say for illustration purposes, if it is 5 kilometer per hour, and if it keeps moving at a constant speed of 5 kilometer per hour, it will move a distance, it will reach its destination within a stipulated number of time, which is within a stipulated amount of time. So that is simple interest, that the car is continuously moving at the same rate. So this is simple interest. What is a compound interest? Compound interest is that the car is now accelerating. So we have not only a faster car, but we have a car which is capable of acceleration. So initially the speed was 5 kilometer per hour, increased to 6, increased to 7, 8, 9, 10. So as the time passes, what do you think will be the difference between these two cars? One is moving, another is moving at a not at a faster speed, same speed, but then the speed is increasing, and this gap between the two cars is also increasing. So that is something to illustrate about the difference between the simple and compound interest. So ultimately, it means that you cover more distance with compound interest, and in a faster manner, because there is acceleration involved. This is a very simple chart that all of us have seen. So simple interest will look something like this. It will also give you growth, but at a linear pace, while compound interest will also give you growth, but at a at an exponential pace. So far so good, nothing very difficult, right? Let us now understand momentum. What is a momentum? So I'll take two examples here. One is of a merry-go-round. So suppose two kids get onto a merry-go-round and they start, turning it. So initially it becomes very difficult and very heavy for kids to turn it. So they step on, one kid is pushing with all their efforts, and it goes round. Then he also on boards. Then it goes down. Then then another friend comes and the friend starts giving it the push. So initially that push was hard. As the momentum develops, all the third friend has to do is just keep touching it. As soon as he touches it, it there is a there is an incremental speed, and ultimately it gets into such momentum that it becomes very difficult for the kids to even stop the merry-go-round. And even if they now don't do anything, it will still keep rotating. It will still keep going on. So that is momentum. So of course, every all of us know, but just to understand it better. Similarly, if we take a train, when the train is standing and there's a wall in front of the train, so it is not hitting the wall, it is not breaking the wall because it is standing. But as soon as it takes off from the platform, gradually that speed builds, gradually that acceleration kicks in, gradually that momentum comes in. But when it is in its full throttle, in full momentum, even if there is a huge wall, or if there are a lot of blocks, road blocks, it will just pierce through all the blocks. It will just go through like that. So that is a power of momentum. So further in understanding it, what momentum is the silent force. So early compounding feels slow. It feels pointless. It is very natural, like a standing train, or a stationary merry-go-round. So it feels very slow and pointless. But as very well covered by Darren Hardy in his book, The Compound Effect, that is one of my favorite book that I read so far. So in that he talks about this phenomena of Big Mo. So he talks about momentum as your big brother, as your friend, as a big mo. So when that momentum is on your side, so that is where the magic starts happening, and that momentum is in all spheres of life. It is in everything. So whenever you start doing exercise, whenever you start saving, whenever you start building your business, whenever you start learning a new skill, so initially it feels very slow, pointless. It also gives a lot of body aches, a lot of boredom, but as we keep on doing it, that momentum builds in. And when that momentum builds in, it becomes so effortless that the craving is another part of it, but it becomes so effortless that it feels like play. Initially, which was very heavy lifting, which looked like very heavy lifting, it became like play. So that is the silent force. That is what the momentum is. So suddenly what happens is the habits start sticking. It becomes your nature. It becomes the part of your value system. It becomes a part of your behavior. The good habits that you develop, they start sticking. The results start growing faster, and the progress then feels natural. So it is about that incremental progress when it becomes natural. So there's nothing stopping us. There is no roadblock as such, and that is when we make the real progress. And like discussed before, inflation, we take example of dirt, we take example of inflation, or for that matter, any sphere of life. So as we grow old, our energy levels will go down, our financial conditions will worsen, and because the inflation is there, and if we are not improving on our finances, if we are not taking care of personal finance, the expenses will creep in, kids will grow up, their education will be there, and of course, everything. So the life will become more burdensome, to say. It will, even financially, even physically, even emotionally, and there will be some sort of midlife crisis, and all those negative things will happen, and the life will start to feel like burden. But what compounding does is compounding rewards you over time. So it is counterintuitive. It is it acts in the opposite direction. So while life in itself will make your life burden, but compounding will reverse the burden. So if we start early, if we let our savings, our skills, our health habits, if we let all of these compound, soon life feels lighter. So it is no more heavier, but it is lighter. And the best part is, as we keep moving on, it becomes even more lighter. So that is the real magic, that the effort Yes, you need not put the effort forever, but that effort will eventually work for you. And whatever effort we have put in the past, all that is now pushing us further. And that is the real magic of compounding. That is how it reverses the burden of life. So, like previously discussed, it rewards the future you. So, small choices plus time delivers big results is what we have understood so far. So even in investing or in our financial journey, there are two things which are very important. One is the rate of return and the time. And this rate of return can be, so as we tweak the rate of return and as we improve the time, so both start working in our favor. And when both are high, that is when the exponential curve appears. So that is the crux we need to understand. So, moving forward, let us see the journey of rupees 10,000 a month over 30 years. So, what we are doing essentially is we are saving 10,000 rupees a month, and we are seeing what will happen over 30 years with the simple saving habit of 10,000 rupees a month. So, here we take three scenarios. One is that we don't save at all. So, this is very common. 99% people do this, that they don't save at all. They just keep earning and they just keep earning, and all that money that they earn, they keep on spending on their lifestyle without saving. So even after 30 years, nothing will happen. The bottom line, right? Second is that we just keep saving regularly. So here we are just saving it and not doing anything, putting it in the bank account. And as we see, it is a linear growth that happens. And eventually, at the end of 30 years, we will still be making a decent amount because we were just saving 10,000 rupees a month. So at the end of 30 years, we will still manage to save 36 lakh rupees, which is not small because considering we are not investing it, but it is a linear growth. Now, let us consider what happens when we are investing this amount in Nifty 50 at, say, a 12% rate. So, this same 10,000 rupees will compound to almost 3.5 CR. This small habit of saving 10,000 rupees a month, if invested in Nifty 50, no brainer, just take a mutual fund or buy an Nifty ETF, start your 10,000 rupees SIP. This will become 3.5 CR rupees in 30 years. Simple. Every all of us know this. A lot of mutual funds have pitched in. So let us move to the next level. What happens next? So we accumulate 36 lakh rupees if we don't invest. But if we invest the same in Nifty 50 at 12% return, it grows to 3.5 CR. But now let us try to dive further and understand that not all returns are equal. Now we are comparing three scenarios. One is FD at 6% return. Second is Nifty 50 return at 12%. And third is direct equity at 25% per year, which is what we target here in Technofunda. So this looks great. The middle line is essentially Nifty 50 line. So this looked great here. I'll just quickly go here. This looked great here at 3.5 CR, staggering difference between 36 lakhs and 3.5 CR. Now what we have done, we have simply bumped up the return to 25%, which is what we target here in Technofunda by investing in direct equities, not following the Technofunda investing system. So this is linear, this is exponential, and this is also exponential with a higher rate of return. What I want all of you to observe here is that as the time passes, just by increasing this return rate, practically what is happening, this gap is also increasing. And at the end of 30 years, while in fixed deposit, one would make 1.02 CR. In Nifty 50, one would make 3.5 CR. In direct equity with 25% of investing, one can make 42.7 CR. Is this huge? Of course it is. The staggering difference is huge. It is 3.5 versus 42 CR. So this is what not Nifty 50 12% return, not even a lot of mutual funds are able to manage. And even if they are able to, so this will be 3.5 CR. But my point is that just by bumping up this return, if we are able to figure out a system that is able to give us better return over a consistent amount of time, so that difference can be staggering. And what we are doing, we're just saving 10,000 rupees a month. That's it. No big deal for any member of this community, I'm sure. So the difference is staggering. The same effort It is the same amount of savings, but just by turning that return dial, the outcome has changed. So this is what I want all of you to have a look and realize. So compounding essentially has two superpowers, right? One is the rate of return. How fast are you growing? Second is the time. How long it builds. So alone they are limited, and together they are unbeatable. So this is why the most successful investors, learners, and creators, they start early and they stay consistent. So the mantra is to start early and stay consistent. And if we can bump up our rate of return, that is even better. So the math behind compounding is very simple. All of us know here. The formula of compounding is the principal amount into 1 plus r by n to the power nt. So n is the frequency of compounding, t is the time, r is the rate of return, and p is the principal, the seed amount, right? So the compounding grows faster with when we give it more time. And of course, principal amount is important, rate of return is important, but here we are talking about just the two things, the frequency of compounding and the time of compounding. So what we can see is that compounding grows faster with more time and more frequent reinvestment. So what essentially we are trying to do here in Technofunda is the core portfolio is taking care of this time. A lot of times we feel that if it is taking 6 months to build on a position, if it takes even an year for to build on a position, or if it sometimes it also takes 1.5 to 2 years to build on a position. So sometimes it feels very boring and not worth it when we compare it with the bumped up satellite returns. But the magic in terms in the core portfolio is time, because when we do slower tranching and we take higher time horizon or higher time frame, so we are able to ride that trend longer. So core portfolio is essentially taking care of the time component of compounding, while the satellite portfolio is taking care of the frequent reinvestment. Because in satellite, if we get an exit, if by booking profit or by making smaller profit or smaller losses, we simply switch to a better stock, we switch to a stronger sector, and like that. So this is taking care of the frequent reinvestment, and core is taking care of the time. Now let us try to understand that why equity is the greatest engine for wealth compounding over anything else. So what we need to understand is that equity is equal to businesses. It is not just stocks. When we are investing into equity, we are essentially taking a share of the underlying businesses, right? So what happens in a business? In business, we create a system, we create a product, we create a marketing strategy and put everything in place. And we sell the product or service and we earn profit. Now, essentially, what happens in a good company with a good capital allocation strategies, with a good forward thinking and futuristic approach, is when we earn more, we reinvest, and when we reinvest, we earn even more. Then we earn more, we reinvest. Then we earn even more. Then we reinvest. Then we earn even more. So this is the magic. The compounding magic in the businesses is that they innovate, they grow the value, and they earn, then they reinvest, then they earn, then they reinvest, then they earn, then they reinvest. So that is how the businesses grow. And when the businesses grow, as a part owner of that business, we also grow. So this is the compounding flywheel of equities. So rupee 1 lakh invested in a great business can become 1 crore, not by chance, but by the simple logic of reinvestment. So if we consider compounding as the engine, then equity is the fuel. Another very simple thing that we need to understand is a lot of times people have aversion towards equities because of the inherent volatile nature of the asset. But the thing is that volatility is not equal to risk. What is risk? Risk is a permanent loss. What is volatility? It is a temporary fluctuation. So this is what we also need to understand while doing our asset allocation, while taking our tranches, while taking our stock positions. That if we have a system, if we know where to set a stop loss, might it be the initial stop loss or the trailing stop loss. If we know that where are we going to sell the position if it doesn't work in our favor, so it is not risk, it is just a volatility. And volatility is a temporary fluctuation. But if we do not have a system, then it is a permanent loss. So volatility is essentially the toll that we have to pay to ride the expressway to wealth. When we go to an expressway, we have to pay a toll amount, right? So this can be considered as that toll that we have to pay to be able to riding this expressway to wealth. Another concept to understand here is the difference between lending and owning. So when we invest in fixed deposit, what happens? We are essentially lending our money to the banks, and there the return is capped, whatever 6, 7%, 8%, whatever the bank is offering. But it is a capped return. That return amount is fixed, and since it is fixed, it is a essentially not linear in true sense, because that also can compound, but still the return is capped. But when we talk about equities, it is like owning a share in a value creating engine. And when this engine creates value, due to the flywheel of compounding, it has an exponential component to it. So that is why owning equity is essential if one has to, one wants financial freedom and wealth creation in his life. So why Technofunda as such? So Technofunda is essentially a combination of technical strategies and technical concepts and fundamental concepts. So technicals tell us when to enter into a stock, when to exit into a stock, when to add into a stock, while fundamentals tell us what to buy and maybe also why to buy, right? So a combination of these two things give us completes the equation that why equities we have seen, when to buy that equity, what to buy, the fundamentals will tell us, and when to buy, the technical triggers will tell us. And if we separate these two, so essentially what happens is technicals alone is like gambling. We don't know what the fundamental is. We don't know what the future trend might look like, what the future growth of the company or the sector as such might look like. So it is almost like gambling because we do not have any conviction, we do not have any process, and any volatility or fluctuation will kick us out of the game. So it is almost like gambling if we are following technicals alone. However, if we follow fundamentals alone, and this is people following fundamental analysis, the only issue there is that the stock might remain in consolidation even if there is no big downfall, because we have done all our fundamental research that the company is great, everything is great, but still the sentiment of that sector might change, the sentiment towards that industry or that company might change. And eventually what will happen is that we just keep waiting for our returns to grow. So it requires a lot of patience. But so technicals alone is like gambling, while fundamentals without technicals is like that your all the patience will be tested because you do not know when to enter. So this was all about understanding the power of compounding. I just wanted to take a few examples, a few thought experiments, and a few practical examples, so that we at least understand as a community this. Currently in the call in the inner circle mind, we have all levels of members. A few of us would have joined maybe yesterday. A few of us might have joined a month ago, and few of us might be veterans here. So this was the basic part to understand why it is important, and at least we should understand the game that we are playing. We should understand the playground. We should understand the domain, and we should understand the power. And since it is exponential, even now a lot of us will not be able to understand. Maybe I'll share the PPT, maybe we can back calculate, maybe we can do our research separately. And if this is bumped up further, if that paper is folded 50 instead 100 times instead of 50 times, it will be even more mind boggling. If we take say 50 steps instead of 30 steps, it will be mind boggling. If we are able to compound for 60 years instead of 30 years, that will be mind boggling. Now I have a quick question for all of you. What is stopping us? So every time we talk about compounding equities, it is very popular that we see the mutual fund returns, the Nifty returns, and we use calculators for 10 years, 20 years, 30 years, all those sort of things. So what is stopping us from playing this game for 60 years? What is stopping us from playing this game for 70 years, 80 years, 90 years? Maybe currently we might be at the age of 30s, 40s, 50s, 60s. What is stopping us from teaching our kids? What is stopping us from creating a portfolio when our kid is just born? Right? And that is one thing. Second thing is what is stopping us, because it is a one time skill. Once you learn how to invest in stocks, how to do the fundamental analysis, how to do the technical analysis, so it is all about imagination and opening up the mind. So that was the main intention of conducting this session. That suppose today Indian market is doing great. 10 years down the line, it might keep doing great. 30 years down the line, it might keep doing great. Say 60 years down the line, it is not doing great. Say it enters into a long consolidation or a big time correction, and we are unable to make money. What is stopping us from investing in US market? What is stopping us from investing in Chinese market then, or changing the economy altogether? If defense is not performing, what is stopping us from changing the sector? What is stopping us from switching from one company to another? So the thing is, the what is stopping us is our own limitations, our own self doubt. What is stopping us is not realizing the game that we are playing, not realizing the domain in which we are playing, and that is the only thing I feel is stopping, can stop us. And together as a community, it is great, because when we are alone, life takes over. A lot of things might happen over the life, right? So this part was the first part of the presentation. Now we will move to the next part, having discussed all those topics, that how powerful this can be. So now I would like to quickly discuss a few of the compounding secrets. Um, so let us simply start diving into those. So here is secret number one. Secret number one, in so now we have understood the power of compounding. We have understood the power of equities. So in equities, how to bump up our returns further, how to get a 25% or more return. It is also possible to get 100%, 200% return in an year. All the diamond members have seen the mind blowing math. We have examples of a lot of investors and traders across the community. A lot of members in our community are doing 70%, 100% returns a year. 25% following the system to the T is definitely not a big challenge, is what I feel. So now let us dive into these secrets and go slightly more advanced. So since this call has a lot of members might not be able to grasp these concepts, while a few of the veterans might feel that these are not rocket science but common intuition to them. But so I have tried to keep it somewhere in midway, that even the veterans get some value. However, if somebody has recently joined in, it does not go like a bouncer. So I've tried to keep the secrets somewhere in between. So let us try to discuss all these secrets one by one. So secret number one is that all the technical patterns we see or follow ultimately try to gauge the demand supply equilibrium, and we have to be on the correct side, on the right side of the equilibrium. So if there is demand for a company while the supply is low, so that is where we have to be. We don't have to be on the side of a company where the demand is low but the supply is huge. So all the patterns that we see, ultimately we have to see those patterns and try to understand the fundamental principle that in the market all the patterns are being created because of these demand and supply of that particular equity. And once we have this concept clear and we understand where we have to be, so the decision making becomes really simple. So that is secret number one. Secret number two is that there are only two kind of participants in the market. One is weak hands and another one is strong hands. What we have to be to bump our returns, we have to be the last weak hand. So we don't have to be such a strong handed investor that even if the script has fallen 50% from all time high, we are so strong that we believe in the 5 year 10 year horizon and we are not exiting. So why it is not advised to stay participated in a 50% fall is that the math reverses. So when we would ultimately going dive deep diving into the math of the compounding, so it reverses. We'll also discuss about it in the subsequent slide. So the thing is that we have to be the last weak hand. So we have to be weak. We have to be on the edge. When all the retail investors are, so as a retail investor, or should I say as a techno funder retail investor, we have two advantages. One advantage is that we know more things than regular retail investors. We have more tools, we have more systems, we have more knowledge as a retail investor. However, in fact, as a community, sometimes when QIC happens, when the core portfolio presentation happen, or even weekly calls when happen, so sometimes our analysis is even deeper than research houses. So that way, when we compare an institution and a technofunda investor, so that knowledge is taken care of, that those systems and tools are taken care of. So that is our advantage. Second advantage is that as a retail investor, we can enter anytime, we can exit anytime. So where we have to be on the edge, that we have to let all the weak hands go, and as the hands change from weaker hands to stronger hands, that is the point to enter. That is where we should be participating. We should be the last weak hand. So that is secret number two. So to understand this, let us see some simple patterns. Suppose a stock is moving up, then there is a strong resistance because of which the correction started happening. And now again, there is a resistance and it is getting resisted. So of course, it is very important to take care of, take only single digit risk, because we can always re-enter if the trend reverses. But what we have to understand and not get shaken off by these kind of things is that there are two participants, weak and strong hands. Whenever there is a fall, we need not worry about that fall. We should always ask if a weak hand is getting exited or a strong hand is getting exited. Anyway, as a techno fund investor, we have a stop losses set. So if that stop loss triggers on a weekly time frame or a daily time frame, we are going to get out. So that is totally okay. What we should not do is we should not worry about any fall, because a lot of times whenever any fluctuation is there, a lot of people message on the group that it is falling crazily, defense is falling crazily, what is happening, and this is happening, that is. So what we need to understand is that whenever there is a resistance and pushback is happening, so we need to understand that what has happened. Just the people who were retail investors or short-term traders have booked their profit, and because of that the price is corrected, or there is a price rejection in the company. What is the price rejection? So whenever company goes to a price, it is because of two things. One is uh, the earnings. Second is the sentiment. So we need to ask ourselves that does the market believe that this company deserves only this much PE, or only this much should be the positive sentiment on the company, and the earnings are also just being able to justify, or the sector as a whole is being able to justify only that PE. So we need to understand whenever the price is being pushed back from a resistance, so what is the underlying issue, and accordingly we need to take our call. And all the patterns like cup and handle or VCP, etc., happen because of this, that the price turns, it goes up, the price turns, it goes up, and as it hits the resistance, it is pushed back. So each time the price is pushed back, we need to ask that what is happening here. Second is the price is able to break out successfully. It has crossed that resistance, and like we understand the polarity principle, now that same resistance has become support. So slightly the things will get more technical, so a lot of members might not understand it. It is totally okay, because it totally depends on what level in the community, or what time, how much time have you spent in the community. So that is totally okay. Just try to listen to the concepts, the secrets, and just try to either take note of it, and I will also be requesting Vivek ji to share the presentation below the recording of this video, so that if somebody wants to check it out, they can check it out again, or even the recording will be available. The members can visit it again. So coming back to the topic, so the price has broken out successfully, and now it is getting pulled back. So what is happening is that let me zoom in a little. What happened is price went up, then people thought, long term investors thought that अभी तक कंपनी ने इतना किया था, उसके हिसाब से दिस इज सफिशिएंट, एंड लॉन्ग टर्म इन्वेस्टेड हैव बुक्ड देयर प्रॉफिट, और they are waiting for the next trigger. The price is correcting, now the price has turned, and now it is again moving back up. तो जब रेजिस्टेंस से प्राइस डिफ्लेक्ट होता है, दैट मीन्स लोगों को लग रहा है कि इसके ऊपर जा ही नहीं पाएगा, इट विल नॉट बी एबल टू मूव फर्दर, सो दैट इज व्हाई पीपल आर बुकिंग प्रॉफिट एंड इट इज कमिंग डाउन. नाउ इट इज सक्सेसफुली ब्रोकन आउट, नाउ इट इज गोइंग अप. So what happens if the people who book profit at 25% profit instead of writing the scripts, if those kind of investors are heavy, or those kind of investors have started booking the profits, so the price will tend to come down. Now when it comes down, this same resistance line is has now become a support line. So what will happen is that ultimately there is a fundamental trigger in the company. Ultimately, there is a structural change in the company because of which it ultimately demands a higher price, say in 1 year, 2 year, 3 years, or so on. So what will happen is when this pullback is happening, the strong hands will come in and they will start exchanging hands with the weak hands. So again, we have to ask if the strong hands are getting out because the company does not deserve this price, or is it the weak hands that are just booking profit because it is their system that at 25%, 20% they have to book profits. And if it takes support at this level, and if it bounces back, so we should not exit. So that is another thing to understand. Third thing is whenever there's an uptrend and it is going in some sort of consolidation, and that consolidation is probably on a dry volume. So we might, as new investors, or when we are new in this domain, so we tend to think that, yeah, our money is not growing, and money is not growing. What we forget is that, say for 30, 35, 40, 45, whenever we started our investing journey, what we forget is for those many years, we did not even invest. Now we are invested, and the stock is consolidating or correcting or exchanging hands for a few weeks or a few months. But now we'll be now what would we want? We would want, अरे क्यों नहीं बढ़ रहा, क्यों नहीं बढ़ रहा, compounding is getting affected. No, compounding is intact because now at least you are part of that compounding. So what we need to understand it, if the script is consolidating on dry volume, so it is absolutely okay, because it might happen that it consolidated for 4 weeks and then in 1 week it moved another 30%. So from this point to that 30%, if you see, it might still be generating decent returns. It might still be generating nifty beating returns. So what we need to understand is that it is okay to be part of the consolidation if it is a small consolidation. And for that also we have systems, and for that also we have indicators like parabolic SAR or Shaktiman, which will take us out of the consolidation. But many times, what my limited point here is that many times we don't even respect that system. First for 30 40 years, we did not have any system. We did not were not part of investment in equities as whole as at all. When we are now in there, so we become impatient. So we should not be impatient is what the crux of the slide is. Next is whenever there's a profit booking, that is also usually the exchange of weak hands between, say the script goes up, it is getting booked, going up, then again the script is getting booked by a few investors, it is going up, again it is getting booked. So unless there is a trend reversal, we should not worry about these small profit bookings. We should be only worried or concerned when the trend has actually reversed. So that is another thing. So in this slide, in this secret, what we need to understand is that there are only two hands: strong hands, weak hands, and we have to be the last weak hand. And whenever there is any price fall at the resistance, as a pushback from the resistance, or as a pullback towards the support level, or if there is any intermediate consolidation or profit booking, if weak hands are going out, it is okay. If our system is not telling us to get out, it is okay, we need to stay. So that is another mantra, another secret. Third secret is that a late entry can be compensated with better allocation, but risk should never be overlooked. Now consider this. A stock is crazy good, say CDSLs of the world, and long-term compounding stocks, BSEs of the world, and whatnot, chemical stocks of the crazy good stock, available at a great price, and it is available very cheap initially. So we are trying to pick the bottom, or we are trying to take the low cheat entry. So, but what is happening is that our exit is not getting triggered and we don't have funds to allocate. That happens a lot. So should we sell a script which is already in good uptrend and switch to this because we think that this is even better script? No, we should not. Why? Because even if we are entering late, if we are not able to enter at low cheat, we can enter at cheat. If you are not able to enter at cheat, we can enter at breakout. If you're not able to enter at breakout, we can enter at pullback. If we are not able to enter at pullback, we can enter at tightening. If not at tightening, there will be another base formation, say after 1 year, 2 year, 3 years, which will be a bigger base. And of course, on the journey, there will be smaller bases. So if you really believe in that script, so the third secret is, and you think that you should have made more in that script. So the third secret is that it can be compensated with better allocation. So the risk should never be overlooked. Suppose if you were taking 1% tranche and you were risking 10%. So instead of buying an extended stock or selling your winning position and switching to a stock just in FOMO is not a good option, because you can wait, and when you actually an exit triggers and you are entering a next stock, so that time you can simply improve your allocation. Instead of 1%, you can take 2% with a 5% risk. So whenever you get that entry point when the risk is less, you can simply increase the allocation, and accordingly you can do it. So suppose if we wanted to take 1%, 1%, 1%, 1%, now we can take 2%, 1.5, 1%, or we can also take 2%, 2%, 2%. Who is stopping you? That is also equal tranching, right? So the third secret is that late entry can be compensated with better allocation, but risk should never be overlooked. So that is the secret to get out of the FOMO. Next secret is that it is the market leaders who majorly move the market. So what happens is whenever there's a correction in the market, so there is a widespread fear in the market. So like it is said that one should be greedy when others are fearful, right? So the point here is, when others are fearful, the market is in an overall correction. So what we should do is, we should not, of course, risk our money. We should also be in cash. But what we can do is, we can start tracking the stocks which are moving first. Why? Because whichever stock is moving first is leading the market. So the thought here is that whenever there is a widespread correction in the market, who do you think will be investing first? Will it be the smart guys, or will it be the average retail guys? It has to be the smart guys, because it is their profession. They are waiting for better opportunities. And where do you guys think they will invest first? They will invest in companies which have better visibility, which have better structural trends, and which will keep moving. What will keep moving? The company which has longer structural trends, that will keep moving. So what we want a stock in our portfolio which keeps moving, right? So where will those initial signals come? They will come at the end of the bear market, or when the bear market is about to turn. So what we need to do is, we need to look for those market leaders. We need to see that what is turning first. And when everybody is in fear, instead of putting all your money in, what you can do is, you can go into cash into your older positions and try to find what are the new sectors, what are the new stocks, what is moving the market. And if you are able to fully allocate yourself in those companies and managing your risk and ride those trends, so that is where the real money is, because the future market will be moved by those market leaders. So that is secret number four. So there are a lot of secrets. I hope I'm not going too slow covering each of these topics. So initially, I thought I will make a lot of diagrams and take a lot of real examples, but that would have been out of scope of this call. So henceforth, maximum secrets will be just a secret, and we can have a small discussion about those. So the secret number five is that a quick fall without change in fundamentals is somebody else's opportunity to buy. So what happens is that the fundamental is intact. A company has received 20,000 crore order book. It has a great order book. Its market cap is what, 5,000 crore, 10,000 crore, say even 20,000 crore or higher. So fundamentally, what has happened is, this company has got an order. And now this company has received an order. It will receive an advance. It will make stuff. It will sell stuff. It will get profit. It will get subsequent. All this will happen. It will take time to happen. But fundamentally, that trigger is there. There is a change in management. Say Access Kids, there was a change in management. Say NSE, there was a change in management. So that fundamental trigger has happened. It will take time for the fundamental trigger to play. So what we see initially is the reaction of the market. What we see, the initial price movement, is the initial re-rating because of that trigger. Now that trigger will take time to play. So that trigger has not changed because the management has changed. It is going to stay for another 5, 10 years. And now, if there is a fall, as an investor or as a techno fund investor, we should not be concerned about this quick fall, because what will happen is the smart guys are waiting for these opportunities. Who is exiting again? The weak hands are exiting. The institutions are waiting to put in more money at a lower price. So as there is a quick fall because of the fundamental, there is some tariff news, some global event that has happened, because of it the market has fallen 2%. The stocks have fallen 5%, 10%. What will happen the next day? The next day there will be a tennis ball effect. What is a tennis ball effect? The price drops, the price goes up. Why it happens? Because who sold? The weak hand sold. Who took it up the next day? The strong hands. And when the strong hands take, the price moves up swiftly. So we need to understand that a quick fall without change in fundamentals, somebody else's opportunity to buy. So we need to understand that what is causing this fall. Is it the market condition? If it is okay. If it is the fundamental change, we need to go deeper into it. Secret number six, the most popular myth that technical analysis is for traders. I believe that technical analysis is much more powerful for long-term investments, because the short-term moves can still be captured through, news. When did the news come? Did it come in the market hours? Did it come after the market hours? It can still be speculated, and all those things can be done. And technically, on a shorter time frame, even if you are just too good at technical analysis, still there will be fluctuation, still the strategies will fail, and the only way to make money trading in that shorter time frame is to take very tight risk and try to increase the reward. That is the only way. But when it comes to longer term investments, so what will again happen is there is a fundamental trigger. There is a structural change in the industry, or there is an say inherent nature of the sector. There's a platform company which does not need a lot of additional capacity or additional investment to grow its capacity, but to grow its user base, it does not need that much amount of money. It is an inherent nature of the company. If there is a monopoly business, it is an inherent nature of that business that as the market grows, since it has powerful moats, not a lot of competition will be able to come in. They will be able to keep going. If there is a shift from unorganized sector to an organized sector, that is a structural trend, and a company is taking benefit of that, it will keep taking benefit of that. So what will happen is these triggers, these mega trends will take the time to play. So tracking every news in such companies might not be a great option. What we can do is we can simply follow technical analysis like we follow in our core portfolios, that we once in a month we make use of Shaktiman, or we just follow a strategy of PSIR, EMA, or whatever strategy we have made. We use the technical analysis to take that objective call. If that objectively that exit has triggered, then we need to first take exit and think about it, what has happened. But unless that technical exit has triggered, we need to write those companies. So I believe that technical analysis is even more powerful for longer term investments than it is for shorter term investments. Why? Because I think the recording might end. So let's see if the meeting ends. What is the time now? Okay, so time is 8. So if it abruptly ends, maybe we'll reinitiate the meeting. So the number seven is longer, and I'll also try to not get too much in depth of these secrets, because there are 30 secrets to cover. So just a heads up there. I'll try to be slightly quick in these things, in explaining these things. Secret number seven is longer the horizon, lesser the noise. So if you want less noise, if you want more peace in your life and more returns in your portfolio, follow longer term strategies. Not like buy and hold and forget, but at least weekly time frames, monthly time frames, good enough. Very peaceful, very easy, long enough and short enough. It is not too short to give you a lot of noise, not long enough to not even letting you know that what is happening in the market and in the companies. Secret number 8 is that no one can predict, but everyone can stack up their probabilities. What we can do is we can see what is happening. Is the company in stage two or the advancing stage? Does it have any sort of sectoral tailwinds? Is it a market leader? Does it have any strong trigger? So we can check these things, and all the things that are being taught to us in the community. We can stack up those probabilities, and we need not predict. Just stack up probabilities. Take your entries, take your exits, take your decisions, and things will happen. Secret number nine is each tranche compounds. So a lot of people, I see, even very senior members are even very senior members face this issue of tranching. They want to go all in at once. But what we need to understand is that tranching helps us manage our risk, which is very important because this game is about risk versus reward. So if there is reward, there is also risk. So if we have to improve the risk reward ratio, we have to reduce the risk, which tranching will help you do. And the second thing is each tranche compounds. So whenever a script is going up, whenever stock is moving up in price, 70 say first tranche compounded 70%, this tranche compounded 60, this 50, next 40, next 30, next 20, next 10. Now as and when this price will keep on moving, it will form bases, it will again break out, it will again form bases, again break out. If that trend is structural, as and when you know that price is moving up, the lower tranches will compound faster. So this will now not compound just by 80%, 90%, because it is an exponential effect. As it keeps moving, this will multiply more, this will multiply more, this will multiply more. And in the longer term horizon, if the trend is really strong, it will not matter if you entered all in or if you entered in tranches. But taking in tranches, each tranche will compound, the risk will be better. The risk will be lesser and the risk reward will be better. Secret number 10 is lower the time frame, lower gains, higher the time frame, higher gains. So if you are looking for multi-baggers in your portfolio, you have to go for higher time frames. You cannot chase a multi-bagger in your portfolio on a daily time frame. Note this down. If you have if you want a multi-bagger in your portfolio, you at least need to have a weekly time frame. But if you want 100x in your portfolio, if you want 100 baggers in your portfolio, they will come with higher time frames, which is the monthly time frames. So that is why the core companies have that kind of potential of becoming 100 baggers, 50 baggers, even 1000 baggers for that matter. So if we are following slow tranching here, and if we are moving to a higher time frame, we will get higher gains. But if we are following a lower time frame, it will give us lower gains because everything is cyclical and those cycles will play out. Secret number 11 is that time frame is directly proportional to your patience. So it is very easy to say follow monthly time frames, weekly time frames, but if you are not patient, it will be very difficult. So choose your time frame wisely. If your patience is low, choose a daily time frame. Take exits, take entry. Everything is fine. Work on your patience because ultimately higher time frames are more powerful. Work on your patience. When you are able to develop that kind of patience, then switch to higher time frames because time frame is directly proportional to your patience, and this is directly proportional to the returns. So higher you go, the more you make. It is something like that. Secret number 12. So when we talk about pivots, so pivot is a logical buy point. It is not a magical buy point. This is one phenomena that all of us need to understand really well. What is a pivot? Pivot is that the price went up, it corrected, and now it is trying to move up. And it is trying to move above the last price, which was decided by the market, because here the price got rejected. Now it corrected, it is moving up, and now it is further moving up. So what is happening essentially is that now the price is further moving up. So what we would understand technically is that something new is happening in the company because of which it is trying to demand a higher price. So that way pivot becomes a logical buy point. But it is not a magical buy point. But many times what happens is we feel breakout हुआ अगले दिन डबल क्यों नहीं हुआ. This is a very common phenomena that all of us get stuck in. We follow weekly time frames. Stock is successfully broken out. It is 5%, 10% above the pivot point. It is going great. It is consolidating for 4 weeks. A lot of people will get out. Why will they get out? Because they wanted it to be a magical buy point. If it is a breakout, why it did not move 30%? Why did it move only 10%? Because whatever the trigger is, because of two reasons it has not moved. One, either that demand is yet to come or that trigger is yet to play. There could be just two things. So market is basically waiting there for the further demand to come or the further trigger to play. So it is a logical buy point. So treat breakouts like a logical buy point and not like a magical buy point, and don't switch your positions unless exits are getting triggered. Third secret is that disproportionate portfolios give disproportionate edge. If you want a disproportionate edge in market, we've already discussed what will happen if the returns are changing from 12% to 25%. people are making 40% returns. In my first year of technofund investing, I made 37% returns. A few of the members have doubled the capital portfolio in a year. So all of this is very powerful if we really, try to get deep into it. And Vivek sir explains this beautifully with a single slide of allocation, that if we allocate to our winners and if we cut from our losers and if we give that disproportionate allocation to our winners, that itself will create the disproportionate. Only 20, same 20 stocks, if we are allocating more to winners versus if we are allocating same or worse, if we are allocating to our losers, will create a huge difference. So disproportionate portfolio, write this down. This is very, very, very important. If you need a disproportionate edge, disproportionate portfolio is the way to go. When you are getting that good trend, when you are getting that good company, it is also okay, in my view, it is also okay to go up till 10 to 20% of allocation if you know where to exit and if you know where to book. If you are good with your exits, nothing is even stopping you from investing 100% of your portfolio in a single company because it is growing your capital. If you know where to exit, if you are patient enough to take that fluctuation, it is okay. So what we ultimately need to do is, at least as a even following a risk first approach, at least we need to allocate more to our winners and cut from our losers, so that at least the winners have more allocations and each tranche can compound, and that can give us the disproportionate edge. Secret number 40: pyramiding increases returns. And there are many ways to pyramid. So now there are two parts to this. One part is that we take equal tranches: 1%, 1%, 1%, 1%, 1%. That is what Vivek sir tells us to go about each tranche, so that as a beginner we do not risk a lot of capital return. That is the only reason he tells us that you should go for equal tranches. The main reason is that each tranche will have lesser allocation, so each fluctuation will be proportional to that allocation. But if you want to bump up your returns further, so we can pyramid. We can take higher base and then we can take lower base and then we can take lower base. That is the first part. Second part is that there are many ways to pyramid. Taking just a crude example here, just a very crude example here. Say this is in the first scenario, it is a 3% tranche. And then it is a 1% tranche, then it is a 0.5%, then it is 0.25, 0.25. This is also pyramid. Where will the average buy price be? Almost here, very close to the base. This is also pyramid, where you are taking 1.5%, 1.25, 1%, 0.5%, 0.25%, something like that. And it is also staggered, that instead of taking it 5%, we are taking tranches at say 10%. So this is more staggered and like a very not a very steep pyramid, but something like that, a very vertical kind of pyramid. Then this could also be a pyramid. So the idea is, one, pyramiding will help you reduce your average buy price and will help you bump up your return. And the second thought here is that there could be many ways to pyramid. It can also happen that instead of pyramiding like this, we can also play this. We can also play the hourglass kind of thing, that when it is the stock is bottoming out, we are investing heavily. Then as and when it is going to the pivot point, we are reducing the allocation, and as it is successfully breaking out, then we are allocating heavily because now we have a new support level and new trailing stop loss. And as it is moving up and now there is a possibility to pull back, then we are allocating less. Then when again the base is forming, then again we are aggressive. So my point is, limited point here is that there are multiple ways to do it. What we have to do is that each tranche is compounding. If we are able to get the average buy price down, we are able to bump up the profit. And as and when the stock behaves, as and when the as and how, like in whichever fashion the price is moving, what we can do is, at least we can keep our thinking hats on about the possibilities of where can we set a trailing stop loss, where can we set a stop loss, what will happen if things go in our favor, what will happen if things not go in our favor, and we can think. Basically, the idea is we can be creative in our pyramiding, right? Secret number 15, which is solid closings give solid results. A lot of time, what happens now, consider this situation. A company is about to announce its result. Now, there are two scenarios here. It will never happen that the company is announcing result and it is, the price is right, because there is a some gap is needed for actually the actual investors to come in and punch in their orders and the prices to move. So there are two scenarios here. A company is about to announce the result and the price starts moving before. What does that signify? It signifies there is some sort of insider trading, or there is some sort of anticipation in the market. So believe this: if we are following technical analysis first approach, if there are solid closings, believe the results are not out, but try to believe, or at least anticipate, that there is a very solid demand in the stock. So maybe I can take a tracking position, maybe I can take my first tranche, maybe I can start accumulating the stock, because you are getting those technical signals. So even when the results are not out, if the closings, the weekly closings, the daily closings are happening so with solid candles, that means the demand is pumping up. So you can at least anticipate the solid results. And anyway, we have the framework to get out. So in that scenario, don't wait for the results to come out. Otherwise, you'll lose on that move. So first, secret number 15 is that solid closings usually give solid results. And there is a vice versa of this, which is secret number 16, that solid results should have solid closings. Suppose the result is fantabulous. One recent example that comes to my mind is Mondana Engineering. Fantabulous results. Everybody is gaga about Twitter. People are betting like anything on that stock. And after the result has come, what has happened? The price is down by a lot of percent. I don't even remember, maybe 5 to 10%. So what does it signify? It signifies that the result is solid, but it does not have a follow-up demand. It does not have solid closings. What does it signify? It signifies that somewhere I am reading the result wrong. Either there is an account manipulation, or there is an issue of receivables, or there is some one-time profit that is then the. So basically, we need to deep down, dive deeper into it and understand that why after the solid result, the solid closing has not come. So if the closing is happening, result is not there, believe it. If the results are good and there is a follow-up move, so that means there is a solid close. So basically, it should have a follow-up move. That is essentially the idea of this secret. Now, the secret number 17 is one of my favorites, which is law of limited choices. So this applies everywhere. We are limited creatures. We have limited abilities. We have limited time. We have limited resources. Whatever resource that might be, to effectively compound your money, your portfolio should not have more than 20 to 30 companies maximum in your portfolio. Even if you have a 100 crore portfolio, 1000 crore portfolio, or whatever, if you have to effectively compound, ultimately it will be limited by the number of positions. So you always have limited choices. So that is why it is important to rank your companies. That is why it is important, so that is why important to stack up probabilities. That is why important to take position in those companies which also have sectoral tailwinds and all, the supportive, like the higher probabilities in their favor. So since we have limited choices, it is better to be patient and accordingly act, because we have limited resources. Whatever that capital might be, we have limited choices is the essence of the secret. Next is secret number 18. So this I learned from another one of my favorite books, which is Psychology of Money, where the author says that one should be reasonable versus rational. What is rational? Rational will be a company that is about to double in next year. I should beg, borrow, steal, and invest everything there because it is going to double my money. That is probably rational. Even if that is not rational, what is rational is that at least I should choose the best stocks. At least I should allocate well to the winners. I should, whatever is fundamentally and technically and all has all the probabilities in its favor, that I should invest maximum in that company or in those scripts for that matter. That is rational, right? But it is okay to be reasonable, because 99% of people are not even reasonable. Consider ourselves 5 years ago, 10 years ago, 3 years ago, or even few of the members who have just joined in. Consider yourself 1 year, 1 month ago. You did not even know that this kind of thing exists, because there are lot of financial lack of financial awareness in our country. So it is okay to be reasonable. It is okay to start small, grow gradually, learn in the process. It is not, it is okay. So the only idea for the secret is that it is okay. Even if you are reasonably good, it is okay. Just keep going on, stay consistent, things will happen. You will get good results. So it is okay to be reasonable versus trying to be rational, trying to control everything and, squeeze out each, a maximum juice of all of our investment ideas. Next secret is that no one is crazy. I might be blabbering something in the session. I might be having certain opinion. I might have some favorite techniques, some non-favorite techniques which might not have worked for me. Doesn't mean something has not worked for me, does not work for anybody else. Right? So no one is crazy. Everybody is trying to do the best, and there are 100 ways to achieve the same thing. What we are trying to do is we are trying to understand what is our what is our dominance, what we truly believe in, what is our value system, and we're trying to develop a system which can give us consistent results. And if somebody else is doing something else, that is totally okay. Even in the community, even after having the same learnings, each investor is investing differently because they have customized it to themselves. So no one is crazy, everyone is good. Yeah, all the investment strategies are good until they are able to help you move forward. Forward is forward. It might be fast forward, it might be slow forward. Forward is forward. So no one is crazy. So we need to respect that, and we need to keep our thinking hats open, and we need to develop that learner mindset. Secret number 20 is leverage alerts and GTTs. A wider thing in this would have been to include technology. That leverage technology would have been a wider umbrella, but I would like to pick this part of that technology, which is leverage alerts and GTTs. So what we need to understand is, suppose we are seeing some sort of pattern in a stock, or we are following up a company from a few quarters or few years, and we know that this kind of triggers might happen. We know that a recent company has done its IPO. And so what we can do is, instead of checking that chart daily, what we can do is we can simply set an alert. And even if we don't have a trading view pro plan, which for alerts, just go to Kite or your any broker app, see on the chart that what is the price which you think at this a particular EMA will be respected. What is that price? Just set an alert on that price. Similarly, if you believe that a script might fall because there it seems that there are some sort of headwinds, and to protect your gains, you need to have some sort of selling alert. So leverage alerts instead of checking the charts and worrying about the stock prices and price movements daily. Leverage alerts. And second is GTT. Now GTT is good till triggered orders. So what happens is that many times in breakout, even though it is a logical and not a magical, but even time buying point, but a lot of times what happens is that when there is a good market sentiment, and there is a lot of liquidity in the market. So that time what happens, a lot of good scripts, we are unable to buy it because they moved very fast, because some institution has entered and that price has moved very swiftly. So to make the most of those buying opportunities, we can set GTTs for buying, and this I believe everybody understand. But what I'm trying to bring out, the essence in trying to bring out here, is that now it is also possible to use GT2 to sell. Initially, what happened is that we had to authorize using TPIN. So even if we put a sell GTT, a lot of times it was not respected because of that TPIN issue, and many times that GTT was triggered, we were unable to enter the pin or take the trade manually, and the price has moved a lot. So what you can do is you can just go to your broker app, and you can authorize TPIN one time if you believe that it is safe to do, and if it suits you. So you can authorize it at once, so that you do not have to authorize it again and again. And you can leverage this GTT not only to protect your gains, but even to trend reversals and all those sort of things. For example, suppose you are over. Let me try to give one example here. Suppose you are over allocated in one particular basket. Suppose defense moved a lot, and you were well allocated there, probably over allocated, and now it is correcting, and you have four scripts in your portfolio, and you want to sell the weakest of it. So instead of selling it immediately, just to switch it, what we can do is we can see that at what price it will make sense to us, that we are not at least doing loss, or we are doing a decent 5-10% profit, and we want to switch. So my point here is that if we have to make our call objective, we should use GTT. If we have to, suppose, let me take two examples here. One is for buying. So for buying, you have three ideas, and you have and now you know that I need to buy this script at this price, second script at this price, third script is this price, fourth script is, and similarly the fifth script. So what you can do is simply, to make your life easier and not worry about it, set GTT on all five. Whichever GTT triggers first, you get it in your portfolio. That is your leader among these five. Be happy with it. Similarly, if you have to take an objective call that if this particular script falls below this price, then I need to get out. Set us a selling GTT. Yes, the presentation will also be shared and the recording will also be shared. So no member should worry about that. So what we can do there is that we can set a GTT for selling and again forget about it and take an objective call. If that price is not coming, if the script is respecting some sort of EMA and bouncing back, so that way we'll be protected from, so that way, we'll be protected from premature exits. But at the same time, if the price really falls, if there is some sort of turnaround, we'll be protecting our gain and we'll have a chance to switch to the next script. So this is also very important. Leverage alerts and GTTs to the maximum possible. This will really make your investing process very objective. And when it becomes objective, you will avoid premature exits. You will avoid, dragging your portfolio with losers. So coming on to the next secret, now we have just a few left. So I'll try to cover these quickly in the interest of time. Secret number 21 is iteration is the only way to eliminate or reduce the role of luck. So what is luck? Luck is when um, the output is in our favor, but that output is not repeatable. In the sense, we just got lucky one time, but it is not repeatable. The next time we try to do that same thing, we will not be able to do it again. So it might happen that as a beginner's advantage, the first stock we bought did well for us. It not be the case that every stock we buy will do good for us. Some of the stocks will perform and some of the stocks will not perform. So to illustrate this secret better, let me take example of a coin. Now suppose you are tossing a coin. If you're tossing it 10 times and you get 7 times heads and 3 times tails, is the probability of getting heads like 70% or is it 50%? It is 50%, right? But this time, luck played its role. That 7 times you got heads and 3 times you got tails. So luck played its role because we tossed the coin for a very less number of times, only 10 times. So that is why even though the correct probability is 50-50, still the luck favored. Now suppose we are tossing the same coin 1,000 times or 5,000 times for that matter. If we are increasing the iterations, now how many times do you think will heads appear and tails appear? Probably approximately 500 times heads will appear, approximately 500 times tails will appear. It might happen 497, 503, that is totally okay. But approximately that probability of getting heads and tails will be closer to 50-50, which is the actual probability. So what does it tell us? It tells us that if you increase the number of iterations, this is a very important concept I learned recently, that if we have to avoid or eliminate or reduce the role of luck in our outputs, iteration is the only way to go. Note this down. Might it be anything? It might be, success in your business. It might be success in your investing. If we are able to keep our minds open, if we are able to take those many number of iterations, we are going to eliminate or at least reduce the role of luck. And since our system is built to favor us, ultimately the returns will be favorable. So whenever you are getting an exit, consider it as an opportunity of switching to a better stock. Never shy off from booking a loss, never shy off from cutting off a trade. It is only the amateurs, you know, who are very resistant in booking losses or in switching their positions. Professionals are always open to switch their positions. They are always open to book their losses. Why? Because the more number of times you'll reallocate, it will have a higher chance of getting gems in your portfolio, right? So it is okay to rebalance. That is the essence of the slide. Next secret is very important. Secret number 22 is that EMAs are X-rays of the sentiment. What is an EMA? EMA is an exponential moving average. So there could be different exponential moving averages depending on what time period are we taking. If we take a smaller time period, say we take a 10 weekly EMA, it will be a faster EMA. If we take a 20 weekly EMA, it will be a relatively slower EMA. If we take 100, it will be much slower, and 200 will be even more slower. So suppose we take four EMAs, and let us illustrate that with this chart. So suppose there are four EMAs in this chart. One is a faster EMA, which is the blue one. So I have set it as like CMYK, C being the fastest, magenta being slower, Y being even slower, and K being even slower. So consider these EMA bands as an X-ray. So whenever you have to take a decision due to any fundamental change in the company, or due to a technical trend reversal or change in the company, always overlay these EMA bands on your scripts, and then try to understand how is the price moving. Now, what do you see? This script is mostly respecting the fastest and the next fastest EMA. There is, from this trend to this trend, there is no point at which it has touched the yellow line or the black line. So suppose if these lines were not there, so we could have taken the probability of this script falling to even 50%, 100%, right? But what happens is that these EMAs are like the X-rays of this price movement or this trend, and these act like supports. One support we all know is the pivot point support. Another support is the EMAs. Now, a stock will take a faster support, EM of a faster support, or a slower EMS support, depends on the kind of trigger. If the trigger is fast, it will take a support of a faster EMA. If a trigger is slow, which means if the trigger is taking more time to materialize, then it might move around the slower EMA. That is one thing. Second thing is, if it breaches one EMA, that is your first exit. If it breaches second, it is your second exit. If it breaches third, it is third. And if it is also breaches the fourth, that means you should be totally out of the company. And these EMAs will behave differently on daily time frame, weekly time frames, and monthly time frames. So accordingly, you can take a call that this trigger is on a daily chart, or I'm following a daily chart, so I need to see these EMAs on daily time frame. And similarly, if you feel that you're following a weekly time frame, so you need to be very cognizant of these weekly EMS, because if the script is moving up and it is getting a lot extended from these EMS, it will have a tendency to come back to these EMS. So even if you want to go 10%, 20% in that company because you know it is a good trend, still it should be closer to the EMS and not very extended. Like you can take the initial 5 to 6% tranches on every high, but if it is getting very extended, you should be cognizant that this might pull back to some of the EMS. So these act like an X-ray. So this is a high recommendation to all the members that if you have not used EMS or EMA bands till now, try to use that. At least experiment with them, because they provide some sort of dynamic support through which we can take objective calls. So in this case, it is a confirmed uptrend, and the fastest is above the slower, then above the another one, and this is the slowest, which is at the bottom. So when the fastest and the slowest, the gap is increasing, the trend strength is increasing. So it can also be used for divergence. So suppose there is a divergence at this point. So this can be considered as start of an uptrend, and then it is simply following or respecting these EMS, and it is moving up, and there is a lot of divergence in all the averages, and these averages are above each other, so it can be considered that it is still in a good uptrend. Second case is of pullbacks. Suppose this is almost like a cup and handle kind of formation. So just a quick disclaimer, all these stocks are like from our weekly ideas only, very recent scripts. I've just not mentioned the scripts here. Which script is this? Because I just wanted to illustrate the concept. So these things keep repeating, so it can be applied all the time. So now the price was, there was a PED in this company. It went up, it got rejected at the support, and it came back. Is there something wrong with the company? What do you think by seeing this? These four EMS are 11, 20, 50, and 100 EMS. So this is a weekly chart for this company. So what do you think? Is there anything wrong with the company, or it is just pulling back to its EMA? It is just pulling back to the CMA. The problem will arise if it breaches even the pink EMA, and if it further goes down, that is the time to get out. But if it is there is a short fall, it is either just respecting that EMA, or it is waiting for some institution to come, or it is just a weak hands are moving out, as can also be seen by the volumes. So this is another use case. Third use case is turnarounds. So there are two turnarounds that I'll talk about. So IPO got up, the price went up, it started correcting, going down, almost a bottom formed out. How to conclude that this is a bottom is that now the EMAs have, just remember the CMYK and set your EMAs like that, or you can also make it RGB. These are like the color codes for that we have in printers. So you can either remember by RGB or whatever color coding you want to do. I have done it like CMYK. So C being the fastest, magenta slower, Y even slower, and K even slower. So in this case, what has happened is C is above M, M is above Y. That means there is some sort of trend reversal, and this is probably sustainable trend reversal because it is supported by volume and the EMA crossover has happened. And further confirmation has come when even the black EMA has been breached, and it will be even more confirmed when it becomes like CMYK. It is just the starting of this turnaround. So even when it moves even further or it consolidates even more, it will be like CMYK divergence. So this is an example of a successful turnaround in this case. Now let us see this example. So this is also a turnaround, but a different kind of turnaround. So here you see this. Believe my cursor is visible. So this was also a low cheat. This is also a low cheat. This is also a low cheat. This is also a low cheat, and this is also a low cheat. But the important point to note here is that here the bands were not resolved. Here also the bands were not resolved. Here also the bands were not resolved. And here also the bands were not resolved. Here the bands are trying to, at this point, there are two things to consider. One, the bands are trying to resolve themselves. And if it further moves, they will quickly resolve. That is first point to consider. Second is that at least the price has now respected the slowest moving average. So the slowest is स्लोएस्ट इज लाइक द लिमिट. सो स्लोएस्ट तो ब्रीच होने ही नहीं चाहिए किसी भी हालत, मतलब 200 100 तो ब्रीच होने ही नहीं चाहिए. तो अगर 100 ईएमए उसने रेस्पेक्ट कर लिया है तो दिस बिकम्स योर सपोर्ट. So if you have to take a position at a very, do a good value buy, it is supported by volume, just trail below the black EMA. That's it. If it comes down, you get out. If it doesn't come out, you keep riding. Second way to enter in the stock could be near this point. This is a resistance. If it breaks out, it creates a new support. So either you treat this black EM as a support, or you draw a horizontal line on this pivot point. You treat that as a support and accordingly set a stop loss and accordingly transfer. That is the second way to do it. So this is also turnaround. This is also turnaround. The difference, so like I told that EMS are like X-rays. So this is what I meant. Both look same if the EMS are not laid over, but if the EMS are laid over, there is a drastic difference between the two. Got it? So we'll move further to secret number 23, which is negative compounding. We have now understood the importance of compounding, the exponential nature of compounding, and all those sort of things. Now let us, but this compound is a two-way sword. It also is positive and it also is negative. So negative compounding is equally powerful. And since we are tranching and averaging up, it is also very important to take care of our exits. And we have to avoid the negative compounding at all costs, because if the money can double in no time, it can also become zero in no time. It can also give you a big loss in no time. So taking example of the simple figure, the price moved up. We took multiple tranches. This tranche compounded 70, 60, 50, 40, 30, 20, 10. At this point, with full allocation, we might be at a profit of 30, 40%. Now, now I want all of you to realize is that if the price falls, say by 10%, so your profit will erode by 30%. So your profit will be, instead of say 40%, it will be say 35%, 33%, something. If it further falls, now it will not be 20%, it will be maybe 15%. And if it falls further, now it might be even 0%, or you might be in a loss. What is the reason for that? The reason for that is, one, the notional gain that you had in this tranche between this the buying price and selling price, that notional gain has reduced. Plus, if the price now moves below 2 to 3 tranches, so suppose we took in this case 7 tranches, and now the price is below 3 tranches, so this tranche has given you bigger loss, this has given you smaller loss, this is almost at break even, the loss of this and this tranche has also been reduced, and even this has reduced. So when the price falls, it erodes the profits like crazy, because if upward it doubles like crazy, below it will erode like crazy. So we have to be really cognizant and always respect our risk. Always we have to respect our exits. So this is the secret, that negative compounding is also a thing. We need to be cognizant of it, especially when we are tranching up. It is great and we should tranche up, but we should be cognizant about our exits also to avoid negative compounding. And whenever we have to set a strict stop loss, it should always be in such a manner that a lot of negative compounding is not happening. It is okay to go off this first tranche profits. It is also okay to go off the second tranche at max, but the price should not be below your third and fourth and all those tranches. Moving on to the next secret, the three M's that matter the most in importance of their in the order of importance. First is margins. That the business that you are investing in should have good margins. It should have good operating margins. It should have good net profit margins, and so the margins should be great. The business should be great, and to protect these margins, it should have some sort of moats. Because if the moats are not there, then some competition will arise, and eventually they will take the market share. They will there will be a cutthroat price competition, and that will be the issue because of which the margins will further erode. So first is margins should be good. Second is company should have moats. And third is the management should have that vision, because even if the margins are good and the moats are also good, but the management is not hungry, if the management has that not a will to grow, so they will just not do the work that can be done with this company, and that way our profits will not our money will not be investments will not be compounding that way. So these are the three most important M's that one can see is margins, moats, and management. For people who do not know what moats are, so moats are you can just Google up about moats and see this term was coined by Warren Buffett. So when we see castles, so in around castles there are moats, like you can consider them like big boundary walls, and the castle is surrounded by water, and water has a lot of crocodiles, which basically doesn't allow the outside competition to come in. So it is like the competitive strengths of the company, the competitive advantages of the company, like a monopoly business or a duopoly business. Correct. Right. So margins, moats, and managements are the three most important M's. Of course, machine formula needs to be seen. So this next coming to secret number 25, understanding the math of getting from 0.25% position to 25% portfolio return is very important. A lot of times we are hesitant in taking 0.25% positions, but what we need to be cognizant of is one, this reduces the risk drastically. This game is about risk versus reward. If we can reduce our risk, that is also giving us a better risk reward, because ultimately we will be investing 100% of our money. It is just a matter of fact of time. We might invest in one go, we might invest in 1 month, 2 months, 3 months, 6 months, or even an year, right? That is totally okay. Again, coming to the same point, we did not invest for many years. Now we are at least investing. So no FOMO, no rush. Go slow, let each tranche compound, let each investment idea mature, let each investment be profitable, and next decision, take next decision. Each week we are getting a lot of investment ideas. Each week we are getting a lot of new sectors. So it is totally okay. There is never a dearth of ideas in the market, right? So why we take 0.25% position or tracking position is because we want to reduce our risk, and how each of these decisions, and what will happen is, if suppose I take I'll give a quick example here. Suppose I take 5% position at one go. How many chances do I get to invest? I get only 20 chances. Versus if I take 3% or say 2.5 or 2% positions in each company, how many chances I get to invest or explore? How many companies do I get to explore? I get 50 chances. But if I take 1% positions, how many chances do I get? I get 100 chances to explore, 100 companies to explore. right? And when we take 0.25% or tracking position, so as especially when we are beginning, this is especially for the newcomers, never hesitate in taking a tracking position or a 1% position, because it will allow you to explore a lot of sectors, it will allow you to explore a lot of companies, and 0.25% will give you 400 companies to explore. Suppose you take your first tranche only at 0.25%, you get 400 companies to invest in. And of course you have to do it gradually, and you will not be getting a chance to invest in 400 companies, because you will be getting profits in a lot of scripts, and you will be adding up there. But my limited point is that if the tranche is small, you get more chances. If the tranche is big, you get less chances. So when you're starting up, start with a lesser number of positions, a lesser position size. If the market condition is not favorable, take lesser positions. If there is a breakout which might result in a resistance and pullback or a cup and handle pattern or anything, take a 0.25%, let it break out, then complete a position. After breaking out, you can take a 2%. So you took 0.25 here, then you took 2%. Who is stopping you? But at least respect the risk reward. So that is the limited point of this. And if this is taken care of, 25% portfolio return, index beating returns are no big deal. So just elaborating that point, that if we take 0.25% ke positions and we risk 10%, so it is just 0.025% of at portfolio level we are risking. And if we give it 100 chances to test, if we take 100 positions with this math, what we will be risking is just 2.5% of our portfolio. That is it. What does this mean? What does this mean? This means कि 1 लाख के पोर्टफोलियो में से 2,500 रुपए रिस्क किया है. Is it not good enough? It is amazing. It is mind blowing. Just by taking smaller position sizes, what we are risking is just 2.5% of your portfolio. That can bump up in a day. In one day, we get 3%, 4% moves in the portfolio also. Over 100 chances, we're getting just 2.5% portfolio. So respect this. That is my limited point. And never shy off from taking smaller position. Respect the math, and it will work in your favor. And of course, there is no limit on the upside. If you get some winners in your portfolio, you add even 1%, 1%. A lot of community members have invested 10% and 20%, and they have made crazy money. They started from 0.25%, 1% positions. They allocated to their winners. They still made a good amount of money. But the crux of getting consistent results is that they're not risking much. So this is a very important secret. Next, coming to secret number 26. Now, there are just a handful of secrets left, so I'll quickly summarize them also. Secret number 26 is that there are cycles within cycles, and the time frame matters. We all most of us have taken part in hackathon and have learned how cycles work, how the companies undergo in each cycle. There's a consolidation stage, there is a decline stage, there's a advancing stage, there is a distribution phase, and all the cycles we know. Now, what we need to understand is there is a monthly cycle, or there is a decadal cycle, there is an yearly cycle, there is a quarterly cycle, and there is a monthly cycle. Or in other words, if we say there will be a cycle on a daily time frame, which will be fast. Then there will be a cycle on a weekly time frame, which will be slow. And then there will be a cycle on a monthly time frame, which will be even slower. So there are cycles within cycles. Why do cycles occur? Cycles occur because the market is trying to find a perfect price, and there are different sort of market participants in the market. Some have a shorter horizon, some have a medium term horizon, and some have a longer term horizon. So because of the diverse nature of all the market participants, different cycles appear. It also happens because of the liquidity of the company. If the liquidity is less, if the float is less, the cycle will be faster. If the company grows, liquidity increases, float increases, the same company will undergo a lesser cycle. And you can do this experiment in a lot of scripts. Take any multi-bagger from last 2 years that we have invested in the community. If you have entered and exited successfully, even if you have made profit, just switch that time frame to a higher time frame and see what could have been your returns only if you were invested in that company without doing anything, slow tranching, slow investing, being patient. If it was a multi-bagger, you will be mind blown. If you believe that Masdog only gives 2x, Just go on weekly time frame, you will realize it gives 10x, and go on monthly time frame, you will realize what it does. Similarly with CDSL, although we follow on weekly, just the limited point here is see scripts like APL Apollo and all those things, Shilcha technology, follow it on daily, follow it on weekly, follow it on monthly. Just see how the returns will change when you change the time frame. So smaller time frame, smaller cycle, medium time frame, medium cycle, higher time frame, higher cycle. So there are cycles within cycles is the point that I want to bring out in this secret. That time frame matters. Next secret is that a fall for one person is an opportunity for another. And similarly, an adding opportunity for one person is target for another, right? Suppose a script was moving up, it pulled back. Now that is a fall. One person will get out, but it is an opportunity to buy for some other person because he was waiting for that pullback to happen. Similarly, we add on new highs. So as a Technofunda investors, we whenever there's a new high, we add to that company. But that same company or that same price is a target for somebody else. So, like we discussed, no one is crazy. Everybody is just following their strategies. Everybody is trying to make the most of the opportunity that lies in front of them. And for as an investor, the best strategy that we can follow is having clarity. Clarity is the best strategy because if you are clear that I need to invest in this company for 2 years, 5 years, your job is done. Let us take an example of NACL Industries in this case. It started going crazy on daily time frame. Everybody was on FOMO. They were ready to buy at any price. Vivek sir took on weekly time frames. He said that I am at 2%, 3% allocated. Everybody related it with CG power that the management is changing similarly. Don't treat this as an advantage, just as an example. Just take it as a learning example. So that time, everybody was under FOMO that either I should buy it at any price, and when it started correcting, everybody was also under pressure that what if it falls crazily, because if there is an upper circuit of 5%, there will also be a lower circuit of 5%. But people who were clear enough that their investment horizon is of 2 years, 3 years, and had that clarity, they were chill. Who was under pressure, who did not have clarity that what is that I'm playing. You need to understand, is it a turnaround that you're playing? Is it a breakout that you're playing? Is it a low cheat that you're playing? Is it a core investment you're playing? Is it a satellite investment you're playing? So just be clear on your strategy, and that is the best strategy. Don't worry about the fluctuations. It is majorly because of the diverse nature of the market participants and not essentially because something is wrong in the company. Next is secret number 28. So try to understand why these things happen. And if you understand the fundamental reason, decision making will be much easier. Whenever there is a sideways action, so it is essentially because of two things. One is either it is the company is undergoing a time correction, or there is a temporary pause due to the market might be waiting for the next trigger. There might be a market condition uh, issue overall, or it is simply there's a pause. So treat it like a pause. Never take decisions in sideways action that it will what because it is not a trend, it is just taking a temporary pause. If that pause is too long, we will get an exit through PSAR or Shaktiman and we can exit, but otherwise just treat it as a pause and chill. If there is a downward action, it is because only of two things: either there is a derating which is happening, or there is an earnings degrowth. So whenever there is a downward action, if it is a fluctuation, chill, nothing to do. If there is a severe downward action, try to understand, get out first. That is important because if there might be either a severe degrowth or there might be a derating which might be happening. So again, we can get our triggers and understand that what is happening through a lot of things which are available on screener and trading view. So whenever there's a downward action, it only because happens of two things: PE compression and earnings degrowth, right? So if you think that earnings are not degrowing and there is a temporary PE compression because there is some international news, chill, because it is a temporary fall and it will come back. The structural trend is intact. It is okay. If it falls below your stop loss, of course you have to sell, but otherwise chill. If there is an upward action, you need to understand, is this upward action because of the earnings growth, or is it because of the re-rating? Because many times what happens is the script is undergoing a re-rating, but we put on our fundamental hat and we are unable to justify this sort of price. We are unable to justify. Why are we unable to justify? Because we are unable to foresee the future. And even more than the future, what matters is the demand and supply. The market is ready to give it a better P. Let the market give. Enjoy your ride. Don't allocate. If you are skeptical, don't allocate, but at least ride whenever, until the exit is not getting triggered, just ride it fully. If you are lucky, if you are getting that re-rating, let it happen. Similarly, if there is no re-rating happening, P is not going anywhere, it is just staying stable, but the company is growing in earnings and you're playing it as a core company. Play it. So understanding this, that why is this action happening? It is only because of the two things, and accordingly we have our answers. Accordingly, we can take our calls. Secret number 29 is that if you are trading explosive stocks, explosive stocks means which double in a quarter, which double in a month, 2 months, 3 months, 4 months, even for that matter, 6 months, or less than 1 year if they double, or if there is a swift 30, 40%, 50, 60%. A lot of stocks, there it is their inherent nature because of the float of the company. There is inherent, it is their inherent nature. So all sorts of explosive stocks, if you're trading, then always have a which have a habit of getting extended. So whenever that extension from EMA happens, stocks have a tendency of pulling back. So if you are trading those explosive stocks, always use the short-term term moving averages for exits, or develop a tendency of selling into strength. Because there you are playing re-rating. If re-rating can happen quick, de-rating can also happen quick. If that quick price upward price movement is because of uh, you know it is because of the float of the company, that downward action will also be that swift because of derating. So what you can do best is you can use faster EMS, and even in the weekly time frames you can at least use the fastest EMA and not rely on 100 weekly EMA for such companies, because the move is fast, the fall will also be fast. So that way at least you'll be able to book your gain well. Or otherwise, if you believe that it has doubled in 3 months, it is okay to sell into strength, book that profit, because again when it consolidates and forms a new base, you can re-enter, but at least you will avoid that negative compounding, or that swift downside. Secret number 30, the very important secret. What does it say? It says that market is not a math problem with one right answer. It is a story about businesses, people, and timing. So don't treat it like a math problem, and don't try to just get the right answer and squeeze the most of it. Treat it as stories and be a part of it. Learn about businesses, see what is happening, and try to be a part of the story. Secret number 31. So this is probably we are at the end of the presentation. So we'll just quickly wrap this up. So secret number 31 is that we need to understand what is core for, what is satellite for. That will give immense clarity. And as discussed, clarity is the best strategy. Core portfolio tracks earnings. So we invest in those companies in core, and track them on monthly portfolio, so that we avoid frequent inputs and output, entries and exits, which can earn at 15% or more, which can have great ROCs, which can have great profit margins and great bottom lines. So in core portfolios, portfolio invest in those companies which are going to give you great earnings. And in satellite, try to look for those companies which have a possibility of re-rating. So these are essentially the two components, earnings and PE. So core is for earnings, satellite is for PE. Be a very long term investor in core, and be a very picky trader, or a very trader with a very sharp mindset of having that open mindset of frequent entries and exits. Although we need not do it on daily, but at least on weekly, be very flexible to enter, be very flexible to exit, and treat yourself like a trader in satellite portfolio and as an investor in your core portfolio. Don't get confused. Create a in your mental compartment, create these two segments. For satellite, you are a trader, you have no hesitation in getting out. If you have to go 30% cash, it is okay. But in core portfolio, you're a very long investor, coffee can investor, you're never going to sell it. Even if the market is falling 50%, you are invested in core. right? So compartmentalize that. That will give a lot of clarity. Last secret, but the biggest secret of secrets, is that compounding can also be compounding. Compounding can also be compounded. So it is very difficult to understand the power of compounding, the exponential growth, like we saw in the initial section of this session. What is the last secret is that compounding can also be compounding, and it can be compounded in all spheres of life. Your learning can be compounded, your health can be compounded, your relations can be compounded. Try to get those network effects. Try to, even in your business, if somebody is doing a business, try to get those network effects in your business. Try to see what can you leverage. Try to see what can you automate. Try to see how can you earn more. Try to increase your allocation. Try to increase your portfolio size. Don't just focus on returns. Returns will come if you are in the playing the right game. Focus on your core active income. Improve your active income. Put it in your passive income. Create a flywheel of that active passive income. That will be a compounding in compounding. Your corpus is growing, but you are also increasing your portfolio size, and that is compounding. Just compounding the active income also, you're compounding the passive income also, and it is a flywheel. And in 15 years, 20 years, 30 years, when we'll meet again, it will create for results. Secret number 33 is also very good. It is realizing the power of self benchmarking. Like we said, that wealth can be compounded, right? Health can be compounded. Similarly, our skills can also be compounded. So benchmark yourself. See what were the results, what were the returns that I got this year. Benchmark, write it on a paper. Next year, set it a higher benchmark. Track your learnings. Track, refine your methods. Do journal your outcomes, and just see that what gave you a good result, what took your profits out. Just benchmark, and each year just bump up those returns. So suppose we compounded 25% returns. 10,000 rupees a month will convert into 45 crores in 30 years. If we just develop this habit, and I believe truly we'll have gems in this community. Why? Because everybody is a lifelong learner here. Everybody has that fire in them. Everybody is, the moment when our community gets excited the most is when we have to write LLL in the comment, when everybody wants to prove that they're a lifelong learner. So we have that hunger in this community. So we have that potential that initially, if we are doing 25%, next year we'll be able to 30, 35, 40, 45, 50. We can create a system at least of getting 100% returns a year, 200% returns a year. And when we will also, develop this mindset of compounding our skills and bumping our returns and self benchmarking, it will not, that habit of saving 10,000 rupees will not amount to 40 crores. It might amount to 400 crores and thousands of crores. And who's stopping you to increase your saving from 10,000 to 1 lakh rupees when you earn more, right? So imagination, there is no limit to the imagination, is my limited point here, that compounding is very powerful. This community, the system is very powerful. We need to just open our mindset, benchmark ourselves, and just become a better person each day. So this is the bonus. So this essentially brings us end to the session, and this is a bonus session, or like the bonus slide. So I have created a compounding checklist for myself. I just tick these daily. So I am trying to compound my mindset daily, compound my health daily, learning daily, skills daily, growth daily, wealth daily, fame daily, relations daily, spirituality daily, and gratitude daily. So this is my checklist. If somebody wants to customize this or follow this as it is, you're most welcome. So this is the last thought that I wanted to leave everybody with, that a simple habit of creating a checklist and just being focused on what actions we can take daily to compound. And the most important compounding of all of this is the gratitude compounding, because without realizing that, we could have just not had the chance of getting into this community or this awareness, or even attending the session or any session for that matter. Just being grateful that at least we got that chance is very important. At least feeling grateful for whatever money, whatever knowledge, whatever relations we have, just being grateful for that, and being grateful daily before we sleep, just giving spending those 2 minutes, 5 minutes to reflect upon that what good happened with us that day, will really help us compound in all spheres of life. So thank you so much. So this was all from my side. So since we are a family, we are part of this community. So I'll tell how this presentation got possible. So essentially, I've been trying to crystallize all my learnings and realizations in form of a book, and I might call it the same compounding. So compounding secrets. So when Vivek sir told in the last session that he will not be available, so the book is not yet complete. It is just work in progress. But I took that initiative and just tried to take that opportunity to fast track it. And believe me, the book is only at level five, say the level of five initial slides, but only because of the initiative that I took, and I had that urgency in my mind, that priority in mind, that I need to do this. I gave it more time, and I was able to make a 80, almost 95 slides presentation and share these learnings with you. So thank you so much all for such patient listening, and all the lovely comments. And so that's it all from my side. If somebody wants to follow my work, so you can just go to nimishrivastava.com, and you can find all the information about my music, about my whatever I do in finance, about my companies and everything else.